Imagine waking up tomorrow morning, checking your phone, and seeing money deposited into your account, not because you worked overtime, not because you sold something, but simply because you own a piece of a company. No trading, no guessing, no stress, just cash flow. Now, what if I told you that ordinary investors are building portfolios that pay them every single month, sometimes every single week, without ever selling their stocks? This isn't a scam. It isn't crypto hype, and it doesn't require you to be a Wall Street expert. It's called dividend investing. And when done correctly, it can turn your portfolio into a passive income machine. Most people invest hoping prices go up so they can sell later. That's growth investing. But dividend investors play a different game. They focus on getting paid consistently, whether the market is up, down, or moving sideways. And here's the powerful part. When you reinvest those dividends, you create a compounding snowball that can grow faster than you think. Small payments turn into bigger payments. Bigger payments turn into financial freedom. Over time, your money starts working harder than you do. But here's the truth. Not all dividend strategies are smart. Some investors chase high yields and end up losing money. Others pick safe stocks that barely grow. And many beginners don't know how much capital they actually need to hit their income goals. That's exactly why in this video, I'm going to break everything down step by step. You'll learn the core dividend investing strategies, from high-yield income plays to powerful dividend growth stocks. I'll show you how to build a balanced dividend portfolio from scratch. We'll cover the biggest mistakes that destroy returns, and I'll even walk you through realistic income calculations so you know exactly what's possible and what's not. Whether you're a beginner trying to build your first passive income stream, or someone who wants their investments to finally start paying them back, this guide will give you a clear roadmap. Because dividend investing isn't about getting rich overnight. It's about building income that grows year after year, quietly, consistently, and powerfully. So if you're ready to learn how to turn stocks into cash flow and build a portfolio that pays you for life, let's get started. Dividend basics you must understand. Before you start building a dividend portfolio, you need to understand the foundation. Because dividend investing looks simple on the surface, but the details matter. First, what exactly is a dividend? A dividend is a portion of a company's profits that it shares with shareholders. If you own shares of a company that pays dividends, you're essentially getting paid for holding the stock. It's like earning rent from owning property, except instead of real estate, you own part of a business. Now let's talk about dividend yield. Dividend yield is the annual dividend payment divided by the stock price. For example, if a stock pays $4 per year and trades at $100, that's a 4% yield. Sounds simple, right? But here's where beginners make mistakes. A high yield doesn't always mean a good investment. Sometimes yields look high because the stock price has fallen, and that can signal trouble. Next is the payout ratio. This tells you what percentage of a company's earnings are being paid out as dividends. If a company earns $10 per share and pays $9 in dividends, that's a 90% payout ratio, which could be risky. A healthy payout ratio generally leaves room for growth and protection during downturns. Then there's dividend growth. Some companies consistently increase their dividend every year. That's powerful because your income rises over time, even if you never add more money. A stock paying $2 today could be paying $4 or $6 in the future if the company keeps growing. Finally, you must understand compounding through dividend reinvestment. When you reinvest dividends to buy more shares, those new shares generate even more dividends. Over time, this creates exponential growth. Dividend investing isn't about chasing the biggest number. It's about safety, sustainability, and steady growth. Once you understand these basics, you're ready to explore these strategies. 5 core dividend investing strategies. Now that you understand the fundamentals, let's talk about strategy. Because not all dividend investors play the same game. The first strategy is high-yield investing. This focuses on stocks paying 5%, 6%, even 8% or more. The goal here is immediate income. This strategy is often attractive to retirees or those seeking cash flow now. But the risk, high yield, can sometimes signal financial trouble. So careful research is critical. Second is dividend growth investing. Instead of focusing on high yield today, you focus on companies that consistently increase dividends year after year. The starting yield may be lower, maybe 2% or 3%. But over time, the income grows significantly. This strategy is ideal for long-term investors who want rising income. Third is investing in dividend aristocrats. companies with 25 consecutive years of dividend increases. These businesses have proven stability through recessions, inflation, and market crashes. They may not be flashy, but they are reliable. Fourth is the monthly income strategy. Some stocks and REITs pay dividends monthly instead of quarterly. This helps investors create consistent monthly cash flow, almost like a paycheck replacement. Fifth is dividend ET. Instead of picking individual stocks, you buy a basket of dividend-paying companies in one fund. This provides instant diversification and lowers risk. It's perfect for beginners who don't want to analyze dozens of financial statements. The smartest investors often combine these strategies, balancing income, growth, and safety. How to build a dividend portfolio. Now let's build a real dividend portfolio step by step. Step 1. Define your income goal. Do you want $500 per month? $1,000? Your target determines how much capital you need and which strategy fits best. Step 2. Choose your approach. If you're young, you might lean toward dividend growth. If you want income today, you might include higher yield stocks. Step 3. Diversify across sectors. Don't put all your money in one industry. Spread investments across healthcare, consumer goods, energy, finance, and real estate. This reduces risk if one sector struggles. Step 4. Check financial health. Look at payout ratio, debt levels, revenue growth, and earning stability. A sustainable dividend is more important than a high dividend. Step 5. Reinvest early. In the beginning, reinvest all dividends to maximize compounding. This accelerates growth dramatically over time. Step 6. Rebalance annually. If one stock grows too large in your portfolio, adjust allocations to maintain balance. A simple example allocation might look like 40% dividend growth stocks, 30% high-yield stocks, 20% dividend ETFs, 10% REIT. The key is balance. You want income, growth, and protection working together. Mistakes to avoid. Dividend investing seems safe, but mistakes can quietly destroy returns. The biggest mistake is chasing extremely high yields. If you see a stock paying 12% or 15%, ask yourself why. Often, the company is struggling, and a dividend cut may be coming. Second, ignoring the payout ratio. A company paying out nearly all its earnings has little room for error. During economic downturns, dividends can be reduced or eliminated. Third, lack of diversification. Putting all your money into one stock or one sector is dangerous. Even strong companies can face unexpected challenges. Fourth, not reinvesting early. Many investors take small dividend payments instead of compounding them. Early reinvestment dramatically increases long-term income. Fifth, panic selling during market crashes. Dividend investors should focus on income stability, not daily stock price fluctuations. Finally, ignoring taxes. Dividends may be taxed differently depending on your country and account type. Smart tax planning increases net returns. Avoiding these mistakes is just as important as picking good stocks. How much money do you need? Now, let's talk numbers, because this is where expectations become reality. If you want $1,000 per month in dividend income, that's $12,000 per year. If your portfolio yields 4%, you would need about $300,000 invested. At 5%, you'd need $240,000. At 3%, you'd need $400,000. This might sound like a lot, but remember, you don't build it overnight. Dividend investing is a long-term game. Let's say you invest $500 per month consistently, earning an average 8% annual return with reinvested dividends. Over 20 to 25 years, that can grow into a significant portfolio capable of generating real income. The secret isn't a massive starting amount. It's consistency and compounding. The earlier you start, the less money you need to invest each month. And here's the mindset shift. Instead of asking how fast can I get rich, ask how fast can I grow my income stream. Dividend investing rewards patience. The income starts small, but over time, it grows larger and more stable. Eventually, your portfolio begins paying a meaningful portion of your expenses. That's when investing changes from numbers on a screen to real financial freedom. Dividend investing is not flashy. It's not exciting. It won't make you rich overnight. But what it can do, if you stay consistent, is slowly build a stream of income that grows year after year, whether you're working, sleeping, or on vacation. Think about that for a second. Instead of relying only on a paycheck, you start building a portfolio that pays you. At first, it might be $10, then $50, then $200. And one day, it could cover your rent, your groceries, or even your entire lifestyle. Not because you got lucky, but because you stayed disciplined. The real power of dividend investing isn't just the cash payments, it's the compounding. Every reinvested dividend buys more shares. More shares create more dividends. And that snowball keeps growing. Quietly, steadily, powerfully. And remember this, the goal isn't to chase the highest yield. It's not to gamble on risky stocks. It's to build a balanced, sustainable portfolio of strong companies that can keep paying you through good times and bad. Markets will crash. Headlines will scare people. Prices will fluctuate, but solid businesses that generate real profits tend to keep rewarding patient investors over time. So start small if you have to. Even $100 invested consistently is better than waiting for the perfect time. Because the perfect time rarely comes, but time in the market is what builds wealth. 10 years from now, you'll either wish you started today, or you'll be grateful that you did. If this video helped you understand dividend investing strategies, make sure you like the video so more people can see it. Subscribe for more simple, powerful finance strategies every week. And in the comments, tell me, what's your monthly passive income goal? Let's build income that works for us, instead of us always working for money.